Well, welcome to Investor in the Family Radio. This is your host, Brian Bain, and again, joined with our esteemed colleague, David Reyes. David, thanks for joining us.
Yeah, thanks for having me back.
Well, this week we're continuing our ongoing series of the Berkshire Hathaway letters to shareholders, and this week we're on the 1978 letter. And of course, I think it's worth pausing. Maybe, I don't know if you noticed, David, that the last few weeks I haven't stumbled over the title of the series. Have you noticed that?
I have noticed that. I feel like you've gotten that good rhythm there of the letters.
Well, every time I start doing the intro, I quickly have a minor panic internally, and I flip the book closed real quick and I read the cover of the book.
It's like when you're at a restaurant, you've been looking at the menu for like 5 minutes, and then you have to look at it again to tell the waiter what you want. I'm like, how can I never remember what it literally was just thinking in my head? So it happens all the time.
Or even worse, like, oh, I haven't picked anything yet. And like, I've come back 3 times. That happened this Saturday. So the waiter kept coming by. We're like this outdoor kind of park area, like a kind of a backyard of a restaurant. And the waiter kept coming by and I'm like, oh, hi.
Yeah. It's like, oh, my bad.
Not ready
yet.
It's
like, hold on. I'll focus on the menu time. Just conversing.
I promise I will.
Yeah.
Turned back to my friend. So this week, 1978 letter. And there's a few things I want to focus on, but I want to touch on a few things on our way there. Because as you mentioned a few weeks ago, these letters are getting longer. There's a lot more to them. And I know that as we move forward, that'll continue to be the case because, as Warren Buffett, as their company as Berkshire Hathaway becomes a broader, more diverse company, there's obviously more to talk about. And I feel like Warren Buffett over time, I think what we'll see is these become much more of a place for commentary on markets and investing in general, as his kind of role in the investing world and stuff like that kind of grows over time and stuff. So, because now, this is 2018. If they just recently had, maybe last weekend actually, they did, what was it? Oh, they had the big Berkshire Hathaway shareholder meeting, and they have having a big arena. People come, will hear Buffett talk and hear different people talk, and they'll discuss certain things. It's like a big, people call it like Woodstock for capitalists. All these capitalists pour into Omaha, like tens of thousands of people will go there to meet up about investing stuff. Is pretty crazy.
Wow.
A couple things I want to hit on. So back to the textile industry. Obviously, that was the company that was the original core of Berkshire Hathaway. And he talks about, there were some things that improved, but overall continues to not be what they want it to be. It says, our management is diligent in pursuing such objectives. Okay, but anyway, the problem, of course, basically such objectives, meaning they're diligent trying to improve the company, essentially. It says, the problem, of course, is that our competitors are just as diligently doing the same thing. And I want to read this because it's important to understand there are lots of different types of businesses, and I want us to start identifying what businesses are great investments and which ones are not as great of investments. And he's going to describe one that's not. It says the textile industry illustrates in textbook style how producers of relatively undifferentiated goods and capital-intensive businesses must earn inadequate returns except under conditions of a tight supply or real shortage. So again, really kind of technical stuff going on there. Basically what he's saying is this. If you've got a business where basically all the product is basically the same from one company to another, we call it like a commodity, then you're just going to you can't expect to have great returns unless there's some kind of significant supply shortage. Because then, unless demand increases significantly or supply gets tightened, it's just, you can't expect great returns because everyone around you can do the same thing you can do. Does that make sense? David, you there?
Sorry about that.
Oh, you're muted. Weren't you muted?
Yeah, sorry about that. Yeah. I was saying
rookie mistake.
I know, here am I. No, I'm glad he mentioned that too, because I'm glad he keeps coming back to it. And just kind of going when we talked about last week, just the reasons why they're sticking around with it. But I really feel like that's just helpful to know about other companies and just kind of comparing the two. I think that's a good nuance. I feel like that he's added in this letter.
Right. Because like the benefits of investing in a commodity company like that, unless there's some kind of a big cyclical change going on. For example, like energy stocks or like any kind of like traditional commodities today, really, owning energy stocks over a period of time can be really up and down. But if you buy them, when prices are low, then sell when they're high, that sounds like a really obvious statement. But like right now, there's been a tightening in supply of oil, for example. Years ago, there was, the big shale boom was going on. Again, if this doesn't sound familiar, it's fine. But years ago, there's a huge surge in supply. Okay. And but everyone's oil costs the same amount of money. Like just because I make oil and it's coming from Exxon versus Chevron, it's still oil. It's just kind of costs the same thing. Maybe I can make it for cheaper than someone else, but it still sells for the same amount of price, generally speaking. But then there was an oversupply, so then prices dropped huge. Then people went out of business because they couldn't make money anymore. And then supply tightened up, and now prices are going back up again. So that's kind of a little bit of what he's describing here. There's a little more to it than that, but I just wanted to highlight that dynamic. And then he goes on again. I circle whenever he mentions the name of a manager, and there's 1, 2, 3, 4, 5, 6, 7, 8. I just 9 right there in front of me. There's probably more that I missed. He mentions 9 managers in 2 pages, talking about, always speaking of them in a very respectful, almost always very praiseworthy manner. And again, reminding all of us the importance of having and hiring and working with great management, whether it be the companies we invest in or who helps guide our investments as well. And then I want to jump over to, let's see. Oh, there's just a sobering piece here. And I know I'm pointing at it. You can't see that, people listening, but I'll read it for us. It says, we continue to look for ways to expand our insurance operations, which have consistently been some of the most profitable operations for Berkshire Hathaway. It says, but your reaction to this intent should not be unrestrained joy. So basically saying, hey, I realize that basically most of our insurance operations have done really, really well. So as an investor, you hear me say, hey, we want to expand into more. That he's like, stay calm. Don't get too excited yet, because then he brings some sobriety in. Because some of our expansion efforts, largely initiated by your chairman, meaning by myself, Warren Buffett, have been lackluster. Others have been expensive failures. Again, Warren Buffett makes mistakes. You will make mistakes. Wow. I make mistakes. And be sober about them, admit them, learn from them. It's going to happen. There's nothing you can do to protect yourself from ever making any mistakes as an investor. That's the whole point. The whole reason I wanted to mention that. I think. Let me see.
Well, I think sharing those mistakes the way he does is pretty sobering too. Because I mean, there's always ways to communicate, put yourself in a better light in most ways, and so I feel like just the way he presents a lot of those things is really amicable. Right.
And let me see one more thing I add here. It says it is not easy to buy a good insurance business, but our experience has been that it is easier to buy one than to create one. However, we will continue to try both approaches, since the rewards for success in this field can be exceptional. Risk reward. He's saying, hey, we don't know. Like, there's risk on either one of these options. We don't know which one the best is. We're going to try both because we believe the eventually reward is worth it. And that's what it comes down to in almost any investment situation is, okay, what risk am I taking? Is the potential reward worth the risk that I'm taking right now? And being able to really identify what risk am I taking and what reward is real is important. And I think a lot of investors don't ever think about that. They just get excited, like you mentioned a few weeks ago, about an opportunity. Oh, wait, this stock could double. Oh, wait, this stock could go up really quick for these reasons. Oh, I want to buy it. And then, yeah, I mean, and that might work out sometimes, but over time, that kind of decision making usually doesn't pay off very well. Or it catches up with us in a negative way, I should say.
Yeah, it's all about the long game.
That's right. Hey, you're learning. Good job, David. Look at that.
See, again, we talked a couple weeks ago, we talked about what I'm seeing in these letters and the trends that I see. And it's like, it just seems like every year it's a reminder of how truly long the game is. It seems like, and especially when it comes to, you mentioned the textile thing and just the and how he expresses his reasonings and, hey, this is why, I know there's been questions here. Well, this is why. And it kind of brings us back to the reason. So I like that.
Yeah. When reading these letters for us and listening to these letters, these podcasts by our audience, again, it's the investment chiropractor. Here's your investment chiropractic session for the week. And we're going to kind of get our minds back where they need to be, focus on good core investment principles so we can continue to make good decisions moving forward. And one thing that I think I want to highlight too is remembering that, first of all, each one of these letters was written a year apart. We're doing them 1 week apart. So there's much more time between them in real life than we have because of the way we're doing them, obviously. But also what I want to be happening for us too is I want the line between buying stocks and owning a business to start blurring. Like, I don't want us to think, okay, here's my friend, the entrepreneur who owns this business or whatever. And then there's that person. Then over here is the person who buys stocks and companies. Man, I want those lines to blur because all that is business ownership. But what happens when we buy and sell stocks, we log into our Fidelity account or whatever broker we may use, and it's super easy to buy and sell companies instantly. And it's super cheap. You can do it for like $5. Okay, I just bought Apple. Okay, I just sold Apple. $5. And you're making these big decisions with all this money. So it makes it seem like not a big deal. Versus obviously you can't go start a business in 3 minutes for $5 or buy a real business out there for that either. And so it makes it feel like one is almost kind of like a game or a hobby versus the other is like a serious venture. And man, I want that line to blur completely. Because as we're seeing with Buffett, he's saying, hey, we make decisions the same both ways. And buying a private company versus a public company, the dynamics aren't different for us. And here he's going to get into, some reasons why maybe he would buy stock in a company versus buying it outright. And basically, I'll give it away. He basically says, well, if a company is doing great, they have great management, and we don't need to have any real say in what the management's doing, then why don't we just stay out of their way? We'll just buy the stock and let that stock appreciate and just enjoy it. Versus in other situations, because if we buy the company outright, it's a lot more involved. It could be more expensive. And then, it's like, well, I can't manage the company better than they can anyway, so I'm not going to try to.
Yeah. And I feel like it's easy, I think, to look for ways to where it's really simple and just, hey, I can do it all on my phone. Right. But I think in a lot of sense, you really lose that, kind of what I'm sensing Buffett's talking about is just the true investment you're making in the company, not just with your money, but it's truly the investment of how well are you educating yourself on what they're doing. It's like, hey, are you, it's got to be worth just as much as you're buying the whole company. That's the big investment to it. And it takes a lot more than just doing things just real blindly is what I'm sensing. So.
Right. Yeah. Well, it's like, I want to understand this business. And here I'll get into, again, for the third year in a row, he lists out the 4 core criteria for their investments. And we'll read them again. So we get excited enough to commit a big percentage of insurance company net worth to equities only when, so basically, we get excited to invest in public companies only when these 4 criteria are in place. 1, it's a business we can understand. 2, has favorable long-term prospects. 3, operated by honest and competent people. 4, priced attractively. It says, we usually can identify a small number of potential investments meeting requirements 1, 2, and 3. But 4, basically, this says priced very attractively, often prevents action. So it says, hey, it's not uncommon for us to find a company that we understand the business, has great long-term prospects, has great management, but it's not priced well. And so we can't do it. It says, we only get excited when all 4 are in place. And talk about discipline. Again, as individual investors, how often have we gotten excited? We pull the trigger. I've done it more times than I want to admit. And I buy a company, but it's like, okay, was it really a good deal? Like, was I honest and disciplined with my criteria? Do I have honest criteria for buying and selling stocks? And am I being faithful to it? Because here's the thing is, there's always the fear of missing out. And the thing is, we will always miss great opportunities. We can't take advantage of all of them. It's not possible. We will miss great opportunities. It's okay.
Right.
It's okay.
Yeah, and I think it's again, it's that fear of missing out. It creeps up everywhere, and I feel like it's definitely creeps up in this type of industries because there's can be so much excitement going on, but I don't see a whole lot of exclamation marks in these letters.
Right.
But so I would imagine there's not there's moments where it's not as exciting, but I feel like these long term things are just what's really important, what he's targeting. I think and I was just thinking earlier, I feel like we need to make an acronym for these four things. I feel like I don't know how we do it. Maybe we can work on. That could be my homework for next time.
There you go. Yeah.
Work on, but I feel like that'd be kind of cool. It's like that way we can refer back to that.
I like that.
Because there's four things and he's mentioned it. Yeah, 3 years. So might be worth doing. Maybe one of the listeners can maybe already has something like that. But
the Buffett 4.
The Buffett 4, yeah. What would that be? So
what would that be? Okay, cool. I like that. I made a note. We'll come back to it. That's cool. Good. Let me see. So now let's jump over to. Okay, I want to continue with this theme here, and then we'll, as far as like how they make those decisions, because I think that's really relevant to all of us as investors. I'm skipping down. So we continue to find our insurance portfolios, and just so the record, the reason he keeps referring to insurance portfolios and things like that is because the money they're using to invest in these public stocks is money from their insurance companies, which is one of the reasons why he loved insurance companies so much, because they brought in so much cash. They can take that cash and invest it in other places, so then his money is making money that way, if that makes sense. So as we continue to find for our insurance portfolios small portions of really outstanding businesses that are available through the auction pricing mechanism of security markets at prices dramatically cheaper than the valuations inferior businesses command in negotiated sales. Point being, so we keep finding companies in this public stock markets. He says the auction pricing mechanism of security markets. So basically saying, like what you pay for a stock isn't necessarily reflective of what it's worth. It's like auction pricing. It's like whatever the public is saying, hey, this is worth is what you buy. So you can get good deals and you can get bad deals versus you can oftentimes find stocks much cheaper than if you went and actually bought the company. It says that, and negotiated sales. So again, if you're buying a company privately, you get together and negotiate a sale price, which usually be a lot more than some of the deals they're getting with the public stocks. Does that make sense?
Yeah,
okay.
Absolutely.
This is this program of acquisition of small fractions of businesses, aka common stocks, at bargain prices, for which little enthusiasm exists, contrasts sharply with general corporate acquisition activity, for which much enthusiasm exists. It seems quite clear to us that one, either corporations are making very significant mistakes in purchasing entire businesses at prices prevailing in negotiated transactions and takeover bids, or that we eventually are going to make considerable sums of money buying small portions of businesses at the greatly discounted valuations prevailing in the stock market. It's a lot of words, but basically he's saying either these companies that are buying like making acquisitions of other companies, they're either making big mistakes, or we're going to make a ton of money because we're making either they're making mistakes or we're making good decisions.
Yeah.
It's kind of a weird way of saying it, but I think you get what I'm saying there. And then let's see. Oh, then down here, jump down. He says, our policy is to concentrate holdings. We try to avoid buying a little of this or that when we are only lukewarm about the business or its practice. When we are convinced of its attractiveness, we believe in buying worthwhile amounts. So again, he's saying, hey, we're not trying to buy lots of little stuff. Like, and this is like I've said before, and I haven't said this in a few weeks, but the idea of, what if as individual investors, we had the mindset, hey, I'm going to put most of my money in an index fund or some kind of more passive investment, and then say, I'm going to try to find one blockbuster investment every year, or maybe two. And so that we can, again, that's the idea of working smarter, not necessarily harder, and figure out, okay, and so, and you're going to miss a lot of great opportunities, but you're just going to wait for an opportunity. Like I have absolute confidence and conviction that this is an amazing opportunity over the long term, and then invest in it. And then if you find one of the two of those a year, and so over 5 years, maybe you find 10, if one or two of those really works out really well, all the rest of them could probably go to zero and you could still be fine.
Yeah, and I like the concept of just going all in because I feel like just what he's talking about, just it's easy to be lukewarm about something and not really worry about it too much, but his whole concept and what he's trying to do is really be all in everything that he's doing and in every investment opportunity that he's making.
Right.
So I like that concept.
Yeah. Yeah. Well, and again, it's like, it requires conviction and discipline and due diligence. You can't do that unless you've really done your homework.
Yeah.
So, and then let me see. I think there's something over here I wanted to read too, as far as kind of some of the philosophy behind making a decision whether or not I want to buy the company or just buy the stock. And so he uses one of the companies they own stock in is called Safeco Corporation. Again, most people like, where does that company now? I'm sure it's been bought somewhere, exists somewhere, but whatever.
Was that the same Safeco as Safeco Field in Seattle? Do you know?
I have no idea. Like, as I say that about the company, someone's probably screaming at their headphones right now, being like, "Are you kidding me? You don't know who Safeco is?" Sorry.
Sorry. I think the Seattle Mariners played at Safeco Field or something like that. So I was just kind of like, interesting. So, but I mean, that's the only reason I know about it is I have no idea what the company is, but it's interesting.
Yeah, well, I could be 100% off on that, but either way,
yeah.
Let's read. Safeco is a much better insurance operation than our own. That's a big deal. He just said, okay, because their insurance operations are like kind of like their golden child at this stage. Like, they love them. They're doing great for the most part, bringing tons of money. He says Safeco is a much better insurance operation than our own. Wow. Okay. Although we believe certain segments of ours are much better than average. So ours are good, but anyway, it says Safeco is a much better insurance operation than our own, is better than one we could develop, and similarly is far better than any in which we might negotiate purchase of controlling interests. So basically, we couldn't start a business better than Safeco, and we can't find one to buy better than Safeco. So it says, yet our purchase of Safeco was made at substantially under book value. We paid less than 100 cents on the dollar for the best company in the business, when far more than 100 cents on the dollar is being paid for mediocre companies and corporate transactions. And there's no way to start a new operation with necessarily uncertain prospects at less than 100 cents on the dollar. Of course, with a minor interest, we do not have the right to direct or even influence management policies of Safeco. But why should we do this, or why should we want to do this? The record would indicate that they do a better job of managing their operations than we could do ourselves. While there may be less excitement and prestige in sitting back and letting others do the work, we think that is all one loses by accepting a passive participation in excellent management. Because quite clearly, if one controlled a company run as well as Safeco, the proper policy would also be to sit back and let management do its job.
How
about
that's
that?
Good. That's good. I feel like that really kind of lays out like what we've been talking about the last few weeks of just his thoughts on good management and just like people is just he really values good management. Obviously we've covered that, but just really just talking about, hey, just let management do its job, let it do its thing. And that's kind of, it's not, he says, while there may be less excitement and prestige, that doesn't mean it's a bad thing.
Right.
So it's kind of nice.
Well, and again, it may sound like a broken record, but I think it's just worth hearing again and saying again, is I get into this thing of every time I hear that and I read that and I just think about us as individual investors. And it's like, man, one of our foremost objectives, I think, should be to find great managers to guide our investing. And that may be an investment advisor. It may be a newsletter provider or a research provider. It can mean several different things. It doesn't mean you have to hire an advisor necessarily, but find some great managers and then trust them. Doesn't mean you have to be blind. You can still make your own decisions, but let them run the first line of defense for your decision making.
Yeah.
I don't know. And so that's what I think. So, but yeah, that's kind of my mindset on that.
Yeah, I don't know. That was a really good paragraph right there. And again, kind of I like you mentioned about Safeco saying how it was a much better insurance operation than our own. I mean, just to even share that, I thought that's a pretty reputable right there.
Absolutely. Absolutely. Well, we'll wrap it up with that. David, thanks for joining us again, man. It's been awesome.
Yeah, of course. Thanks for having me.
And all of our listeners, we thank you so much. It's a blast to be with you. We love your feedback as well. You can always reach me at Brian, Brian, at investorinthefamily.com, or visit us at investorinthefamily.com to hear old podcasts or get new updates. We'd love to see from you or hear from you there, and we'll talk to you again next week. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.